You want to have savings, you want to have extra payments, you want to have some sort of buffer in your life. So you're not in a position of going, holy hell, interest rates have increased once and I'm not affording my home loan repayments, right? You don't want to be flying that close to the sun.
G'day guys, welcome to the MTDC Lounge. This is a podcast that breaks down everything you need to know about designing and building your ultimate home and what to expect. Whether you're a DIY renovator, a budding developer, or everything in between, we'll dive into the building journey, touching on what to expect, what's next, and how to go about it. We'll hear from a heap of experienced consultants and trades about all aspects. So let's get stuck in. Welcome to the Lounge. Welcome to MTDC Lounge. You're here with Matt, your host, and we've got a regular visitor, Nick Jones. How are you, mate?
Good, buddy. Good. Thanks for having me back.
Aussie.
Yep.
Made the last episode we had, it was a ripper. We had some great banter. We had a great conversation. It was real content heavy. But tonight I want to nail down on what's going on in the industry, how people can navigate it, and best results.
Mate, content heavy. We didn't get halfway through the questions.
No, we didn't. We could rip in all day. So hot off the press, mate.
Yep.
What is going on with the RBA? What's going on with the interest rates?
Interest rates are up, man. Everyone knows about that. Look, it wasn't unexpected with the inflation data that came out towards the end of last year and then into New Year with unemployment data. Again, that came out over that period as well. I think the market was factoring a 70% chance of interest rates going up, and obviously that's what happened. Most banks had sort of preempted that. They'd started lifting their fixed interest rates probably at the end of last year, start of this year. So frustratingly, it wasn't probably a massive surprise. And look, to be honest, and no one knows where these things are headed. It all depends on the data and all that sort of stuff that comes out over the next few months. But most banks are predicting there will be one or two more increases over the next 12 months.
Yeah, it's such a stark difference from, I guess, what we were talking about last year. Like, I remember the conversation we had. I was like, mate, what are we going to do about the interest rates? You go, mate, don't worry about it. They're going to chop them 3 or 4 times at the end of next year. And here we are at the start of this year.
Well, this is the thing that people need to remember too. And I'm always trying to remind people of this. Right? I've been doing this a long time. Obviously, we do a lot of referral business and first home buyers and all that sort of jazz. And as a mortgage broker, there's nothing worse than someone ringing and saying, I can't afford my repayments, right? It doesn't happen often. But of course, when interest rates were rocketing up a little while ago coming out of COVID, it was pretty scary times for people. So the thing to remember is rates can chop and change all the time, right? So, there's a few things you can do to sort of shield yourself from it with fixed interest rates and stuff, which we can talk about a bit later. But people need to keep in mind that even though there was all that expectation we're going to get rate cuts last year, and we got 3 of them, and that was fantastic. Towards the end of last year, people started to feel like they might have had a bit more money and all that sort of stuff. That can turn on a dime. Do you know what I mean? If inflation does stay higher than the Reserve Bank is hoping it will be, and unemployment stays low, then there's every chance that interest rates will increase. And then, and obviously that's what happened. So my piece of advice, I suppose, to people is just always be prepared. You want to have savings, you want to have extra payments, you want to have some sort of buffer in your life. So you're not in a position of going, holy hell, interest rates have increased once and I'm not affording my home loan repayments, right? You don't want to be flying that close to the sun.
Yeah. So we know when you go and get your loans, you'd know best, at COVID stage, they were going, can you pay 4 times your interest rate? 4 times your interest rate at 2.5% was magic.
Yep.
Thanks very much. We'll take that every day.
It wasn't hard writing home loans in that pyramid. Anyone could service a loan. Yeah.
But when you start nailing it down and you're like, righto, we're at now 6% and 4 times 6% is never pretty, right? So
yeah, the thing that people need to remember, right, is that Reserve Banks, they're there to serve a purpose. So a whole bunch of different things, right? Inflation and unemployment being the 2 big drivers that they're looking at, but they're always trying to get to an equilibrium. Okay, so if the economy is doing too well, which in my opinion, when we're coming out of COVID, it was, right? There's a lot of government money out there. People could put their mortgages on hold for a certain period of time. A lot of businesses didn't have to pay tax. There was instant asset write-off for small businesses. All these sort of incentives out there. There was a lot of cash in the economy, right? Which means at some stage, inflation is going to go nuts because people can afford to spend. And to be honest, we did. As a country, we did. So then the RBA has to try and bring that back down again. Do you know what I mean? I'm not here to defend the RBA, but reality is if you've got inflation sitting at 8%, basically where it peaked, if it stays like that for several years, you're in a hell of a time. Doesn't matter what interest rates do. You can have really low interest rates, but if the cost of everything is so expensive, then you're getting screwed over the other way. Do you know what I mean? So again, people need to remember that the RBA exists to try and keep that equilibrium, right? They try and keep inflation somewhere between 2 and 3%. They try and keep unemployment low, but at the same time, they actually don't want it to be zero.
Yeah.
Right. So that's the sole purpose of their job, which means that when data comes in that pushes it one way or the other, they will make a change. And, they need to look at it a holistic approach, and they're not really going to look at it and go, can this one person afford their mortgage? That's obviously not what they can do. They just go, can the country overall sustain an interest rate increase? So again, people just need to be prepared for it.
Well, I'm gonna ask a really, really horrible question. I mean, you're getting the government's hitting us with, like, everyone's trying to reach that Australian dream. They want to own the homes, they want to do all that kind of stuff, and then they go and do something stupid like, hey, every new homeowner can now do a 5% loan, and not only do a 5% loan, we'll increase your 5% loan on $1 million. I don't know how many first homeowners that probably any, if any, can afford a $1 million loan. And then when they say, righto, we've got a 6% loan, that you're right to spend that, and then they go and boost all the percentages, you're just going to send them down the toilet. And then I mean, there's so many schemes and options available at the moment. You'd know them better than I, but like the government owns half your mortgage with you and things like that. It's in my opinion, it's going to be a recipe for disaster. People are going to come into these new home loans or these new construction loans thinking that they can purchase these places, and then just get absolutely stitched up with a massive increase in loan prices.
And that's the thing too, like it's the Australian dream is great and it's important, and I do feel like unfortunately people are losing sight of that because home ownership's becoming so unaffordable. And to be honest, interest rates don't really make a massive impact on that, right? This is house prices, right? That's the real killer. And look, there are so many schemes out there which, if you're looking at it just as a first home buyer, they're actually fantastic schemes, right? Like, you can basically, within certain thresholds, it changes in areas and state to state and all that sort of stuff. But around here, you're typically not having to pay any stamp duty. You can buy a house with a 5% deposit, all those sorts of good things, which, again, looking at it from the eyes of a first home buyer, that's fantastic, right? And we do help people out a lot with those loans, and it allows people to get in the property market. The flip side of that is, if all that does is push up property prices, you're screwed anyway.
Exactly.
Do you know what I mean? If you get in, maybe not, but you need to afford your hell of a mortgage, which again is where that come back to that borrowing capacity stuff. But if all that does is continue to push up house prices because there's a shortage of supply, then overall as a country, you just end up in a worse and worse spot. Like, we've been talking about the housing crisis now for a decade. Yeah. Do you know what I mean? Like, this is not new
million
news.
Houses by 2027 or something like that. Something crazy.
Yeah, the simple thing is we need more houses. It's supply and demand.
Yeah.
And governments are talking about it. Everyone knows that. This is no surprise, but it's actually getting them done, getting them built.
Yeah, absolutely. Yeah, you've got trade shortage, you've got skill shortages, you've got, we're shooting for a low employment. A low employment, but higher rates and things like that. It's just a recipe for disaster. Like from an outside looking in, it just looks like a whole lot of mess. It's going to be a perfect storm at some point. But what we'll do, we'll bring it right back into, I guess, what will keep everybody here listening today. What does it mean for everybody who's trying to get into the housing market, purchasing, construction, all that kind of stuff? What are the things that they should be watching for when they get the big four, fixing rates now, or like lowering these variables? What are these things that these people should be watching out for to know that they should be ready? G'day guys, just quickly, if you're finding this podcast info relevant to you, then I'd like to quickly talk to you about what we do at MT Design Collective. You hear us talk all the time about the importance of solid, detailed home design practices, so that you're not left with extra fees, delays, or unexpected costs in building your ultimate home. Here at MTDC, we design homes and provide plans that builders love to build and councils love to approve. If you're looking at a renovation, a new build, or alteration, then we'd love to help you work out the next steps forward. Book a free, no obligation chat with us, and we'll come out to your site, as it's the only way to truly get authentic, no bullshit advice. Link is in the show notes. Okay, back to the show.
The thing, and this might sound like a bit of a sort of throwaway line, but put me to focus on where they're at, right? So it's all well and good to say, okay, interest rates are increasing, it's time to fix in my interest rate today. That may not necessarily suit your situation. So just to give you a bit of an idea, I was only reading the other day, it was NAB said that when interest rates started to come down, so say this time last year, 3 interest rate cuts last year, when they started to come down, 90% of their borrowers didn't change their repayments. So something that a lot of people aren't aware of is when interest rates reduce, most banks, some do, but most banks will not automatically reduce your repayment. That sounds unusual. Now, a lot of people will ring me and go, hey, my repayments haven't gone down. What's going on with my interest rate? Can I refinance? I go, no, your rate's gone down, but they won't drop your repayment unless you actually contact the bank. So say your repayment's $2,000 a month, it should go down to $1,900. Well, that's pretty low, but they don't actually drop the repayments, right? So
you're $100 ahead.
So you're $100 ahead.
Hopefully.
That's exactly right. Yeah. So what happens is when interest rates start to go back up, it's actually not a bad thing because you've got that buffer. So if you've managed to sort of maintain that position and kept at those repayments, that was my advice to people. People ring and go, look, my repayment hasn't gone down. And I go, well, you're still actually getting $100 ahead. Like, do you need to drop your repayment? Is your cash flow that tight? And to be honest with you, most people said no. And I go, great, just leave it where it is because you're actually just getting further ahead on your loan. So when it comes to sort of these big decisions around what do you do with what do you do with your loan when interest rates start to fluctuate, you really need to think about how it impacts you. So for example, what you can do is you can split your loans. You do part fixed, part variable, which is what a lot of people are doing at the moment. And that's just all about hedging your bets. Okay. Yeah. So it gives you the flexibility of having, say, you've got a $500,000 mortgage, you might do $250 fixed for 2 or 3 years, whatever it is, and you might do $250 variable. That gives you the ability to make extra payments on the variable split. You can have offset accounts, you can redraw, you can try and pay your loan off quicker with no limits, all those sorts of things, but you've still got half your loan fixed, sort of guarding against or hedging against interest rates continuing to fluctuate. So to go right back and answer your question, you really need to think about your specific situation. You know, if interest rates go up, is it really the end of the world, or are we just back to where we were about 6 months ago when interest rates were at this point?
Yeah.
You know what I mean?
Right.
So
yeah, okay. So and I mean from I guess 6 months, or let's call it a year, so we can have the full spectrum. So from a year ago to now, how many interest rates has there been increased, and how much difference, I dare say, if nobody's changed their payments from the last 12 months to now? Like,
well, they're still lower. We had 3 rate cuts last year, 1 increase.
Yeah, right. So as long as they didn't go and change their payments throughout that last 12 months, they should be right. Well, there you go. It's not so doom and gloom.
No, and it's not the end of the world too. It's, you know, like, again, the second that interest rates go up, obviously my phone goes ballistic and everyone starts ringing, which is fantastic. But a lot of my job is actually just reassuring people and going, guys, like, are you okay? Cash flow wise, you're all good. Do you need to consolidate some debt? Do you need to potentially extend your loan term to help out with your cash flow and those sorts of things? And most people just go, oh, no, we're fine. We just want to make sure our rate's competitive. You go, yeah, it is. Okay, well then just keep weathering the storm.
Yeah. So they're the guys in. So you're in, you're sweet, just keep paying your money. Make sure you're looking after your budget.
Yep.
What about the guys that aren't in? What about the guys who are searching for their funds, that, you know, first homeowners, whatnot, doesn't matter. Well, if you're not a first homeowner, you should be veteran now. But the guys who are looking at doing that construction loan, or, you know, they've come out, they've got that price available, and they're still going through the planning process. Yeah,
100%. It's a really important point, right? So when interest rates, I'll go back a step. I think we spoke about this last time when we caught up. Banks don't look at what you can afford based on today's interest rate. Okay, so typically, this changed a little bit from bank to bank. They typically put a 3% buffer on top of the interest rate. So for example, if you're paying or you're applying for a new loan, the interest rate's 5.59%. The bank's going to put 3% on top as part of a buffer and go, right, can you afford it as if interest rates are 8.59? Okay, and that seems like a big buffer. To be honest, I think it is. I'd rather it be a little bit lower, but it is to you know, account for when interest rates do fluctuate, right? Which is the position we're in now. What people need to be aware of is, say, for example, they want to start doing a knockdown rebuild on their block of land, okay? So they go through the process, they engage someone like you, they get all their plans done, they engage builders, get quotes, spend a lot of time, effort, and money, and stress behind it too, right, going through that process. They may be able to afford that at the start, but if it's line ball, you get 1, 2, 3 interest rate increases. When they go back to actually apply for the finance, get their loan formally approved for that construction, again, they might have spent a bucket load of money on, you know, plans and council permits and all that sort of jazz that you need to run through. They may find themselves at that point in time going, we can't afford the loan. Or the bank saying, sorry, you can't afford the loan. Or me going, sorry, guys, you can't afford the loan. You may have been able to afford a $600,000 knockdown rebuild 6 months ago, but you can't. You know, if we had 3 interest rate rises in that period, all of a sudden you can't. Because, again, going back to that assessment rate, if the rate's 5.59, the assessment rate's, say, 8.59. If the interest rate's 6%, the assessment rate's 9%. And that's the real killer for people. So I think anyone that's thinking about going down that construction road again, whether it's knock down, rebuild, or buy a new block of land and build a property on that, they need to have that sort of buffer built into their capacity. If someone came to me and I did the whole loan for them and said, or did the whole scenario and went, guys, this service is by $5 a month. Like that's what surplus the bank thinks is in there. My first thing will be, I could say to them, look, technically it works, but you're putting yourself in a hell of a position if you go ahead and commit to all these costs and you're signing contracts and doing all these bits and pieces and you get to that point in time, you can't afford it. So it's a really important point when people are going through that construction phase. No one knows what interest rates are going to do. Right? People ask me all the time, what do you think they're going to do? I was going, mate, no one knows. If anyone tells you know what interest rates are going to do, they're full of shit. But you just need to build in enough buffer and go, okay, so if I really needed to, I could close my credit card in 6 months' time and that would help my borrowing capacity. Or, you know, I'm going to do a bucket load more overtime. I'm going to save up some extra cash and that might plug that gap. Or I'm in the process of selling my car and paying off my personal loan, whatever it may be. You need to sort of have those contingencies when you're looking at doing builds before your finance is going to be locked in.
So, and that's not even accounting for, the variations and all the color stuff that's going to come out, and definitely 100% every day of the week. It will happen during the build. And I think that's one of the conversations that I have with the clients as well. Like one of the first things I have a chat with when they're sitting in that chair, I'm like, hey, what's your budget?
You do podcasts with them.
Just that and design mix. But no, so when they come in and have a chat, I'm like, well, what's your budget? Where are you sitting at? And then they'll say, oh, I'm looking at 150 or 200, whatever the number is. I'm like, okay, great. All right. If you stay absolutely to the letter of this plan set and you are absolutely clear of what you're looking for, that's probably a healthy budget or whatever they're looking for. But, that's not taking into the account, people want to, get the brass fittings. They want the 600 by 600 tiles. These are the things that they don't really consider. And particularly when they're trying to get funded, you take the construction docs all to the bank or yourself and just say, hey, this is what I'm doing. On paper, that looks legit. That looks fine. But, all of a sudden, you're getting water filters.
This is why banks don't like owner builders. That's that, right? Things can change through that process. You get cost overruns and all that sort of jazz, and all of a sudden you're going, I can't afford this build. That's exactly why banks don't like
and it just sits there. And then unfortunately what happens is that you've got a builder who won't finish the build because they can't get the money. You've got the client who owns the house who can't finish the build because they can't afford they can't do all the bits and pieces. So it just becomes an incredible nightmare, particularly over just such a small increment in an interest rate rise could absolutely blow everything out of the water.
Look, it's hard to put an exact figure on it. It depends on everyone's personal situation, but it's typically about $25,000 to $30,000 that an interest rate increase would take out of your borrowing capacity. So that doesn't sound like much, right? You get 3 of those. Like remembering last year we had 3 drops. You get 3 of those. That's about $100,000 less you can spend on, say, your build. But you've committed to your builder. You've committed to your plans, and you've got your whole dream done. Like emotionally, you're committed to building this new house that you want to do or doing this significant renovation, whatever it may be. And then I'm the one going, look, sorry guys, $100,000 short. And the only way to fix that is to either, again, consolidate some debt, credit cards, work harder, get more overtime, save more money, all those sorts of things. And that just adds time and time and time. So all of a sudden that dream is a lot further down the track.
That's strange. Well, would you suggest, understanding the volatility in the space at the moment, would you suggest at any point maybe waiting that 6 to 12 months, like as they come shooting up, and then you've got such a crazy situation at the moment where they go, well, hang on, we've boosted so high, we've boosted so high in the last 6 months. And we know that you increase rates a lot. It doesn't show through the system until the
takes time.
It's a slow burn, right? People start realizing, well, hang on a minute, I can't actually spend that money, and then they start slowing up, and then that's when it starts dropping.
Look, I don't love the idea of people having to wait, only because everyone always says, and you're right to say it, but it's always the case. We're always in a volatile market. Do you know what I mean? It's like, okay, house price going up and down, because again, in Australia we're obsessed with it. Like, so I sell you, it's what you do. It's sort of we're really heavily reliant on the housing industry. As a country. So, what's to say in 6 months' time that things might have calmed down? Like what is calmed down in terms of interest rates? Is it 3 years of interest rates going nowhere, just staying flat? Because that's not going to happen. Realistically, it's very unusual anyway. It could happen, but it's very unusual. So I think what they can do to sort of prepare themselves if they do want to commit to the dream of, doubling the size of their house or going up or building a granny flat or, doing some sort of development, is getting that finance organised as you can right at the start and making sure there's plenty of buffers in place. So an example is if, like I was talking to some clients the other day, they basically own their place at Belmont outright. It's a very small loan on that, and they want to do a knockdown rebuild. So we've gone through their borrowing capacity, and they've got plenty of capacity to afford it. But they're going to go through and actually access the equity from the block first. So they're going to have the money. It's a bit of a unique situation because they've almost paid their house off, which is quite rare. But one sort of strategy that I put to them is, how's about we go and access all that equity in cash? We tell the bank what you're doing with it, and you just got to fit the bank policy. But we go and actually access all that cash and just sit it there. You sit in an offset account, so not paying any interest on it, but then you've actually got it ready to go. So it won't matter what happens with those guys if interest rates were to go up or to go down, because they've already got the money. As long as they can afford the repayments, which they can, there's plenty of buffer in there. But they won't be impacted in 6 months' time when they commit to the build. So there are ways around that to sort of guard yourself from it a bit.
So so let's say that client decides to go and pull all that money out and it's sitting out in their bank account at the moment. Would they be obliged to, let's say they take it out at a really, really cheap interest rate. Let's say they got it at the drop of the 3, and then all of a sudden they take that money, get that loan, get that equity available, and then they boost that equity rate. Would they have to give that money back at the same rate, or would that money essentially be the same value that they took it out on?
Oh, I mean, if they're going to have higher repayments, of course, if the interest rate's gone up.
But if it's sitting in an offset account, they wouldn't pay. It
doesn't matter.
It wouldn't be paying any interest rates.
No, but it's sitting there ready to go.
Yeah.
Do you know what I mean? If they waited 5 years and then obviously the cost of the house has gone up, they're not going to be able to afford to do what they want to do. But this is more of a sort of 3 to 6 month plan.
Yeah, right.
And again, it's a bit of a unique situation, but there's certain things you can do. So say you're going to do I don't know, you might have $1 million house, they're ready to go, and you might have a $400,000 mortgage and you want to do a renovation for $400,000. You just want to access the equity now.
Which is 80%, right?
Spot on. Yeah, that's why I use those round numbers because my math ain't that good. But you go $1 million house and 80% land, which is as high as you can go, no mortgage insurance, you've got an $800,000 loan. If your current debt is $400,000, then you've got $400,000 worth of usable equity. Now, as long as we can show the bank your serviceability, so you've got the income to service that debt based on your income, liabilities, dependents, all those bits and pieces, you can access that cash, right? You can access that cash now and start planning for your build. Again, this would have to be a tight scenario, but just to be dramatic, say interest rates went up 3%, right? That's very dramatic, but just say that it did. They may not be able to afford it to borrow the money in 3%, in say 6 months' time if rates had gone up that much, but they can afford to borrow it now.
Yeah.
Now, again, they've still got to be able to afford the repayment, so people need to be comfortable with their situation. But if you borrow the money now, you're ready to rock and roll. You're not going to get stuck in that awkward position of now I want to start my build, but shit, interest rates have gone up and I'm $100,000 short.
Stuck. Yeah.
Yeah.
So it's all the rage at the moment, and people are buying blocks, building granny flats or dual locking, ignoring all the fees that come along with it, the contribution, the planning, all that kind of stuff. In your opinion, because it's going off like a frog in a sock at the moment, is it a good call to start considering these multi-dwellings, these granny flats, to actually start helping fund, I guess, a construction loan? There's been several people, 10s, 20s, 20 people that have come in at the moment and said, hey, listen, we want to put a granny flat in, not for any other purpose, but to actually start making money from the block. And that's helping them build this. As a matter of fact, I had a lady that I went out and saw at Medowie a couple of weeks ago, and she mentioned that she wanted to put a whole house on the back of the house that she currently has, rent out the house that she's got. Only so it would fund and bankroll the house at the back. Like it's definitely a strategy, I guess you'd call it in the development world. Like, would you agree with it? Are these the things that you would suggest people are buying first home or even investment properties, if they can do it at the moment, should be looking out for? Yeah,
100%. I mean, you've got to think about maximizing the asset that you've got. Okay. So again, just go back to that example. You might have $1 million property, just say it's investment, $1 million property, $400,000 mortgage. You've got $400,000 worth of usable equity. Now you can go ahead and build a granny flat for that sort of money. I remember when you could build them for like $80,000, but that was some time ago. It's long disappeared. Mine cost me 90. Mum lives, is it? Shout out to Mum. But what you can do is borrow that extra money and invest it in that block, right? Now, obviously, you could take that, again, forgetting serviceability, just say all that stacks up. You can access that equity and go buy an investment property. That's great, but you're going to obviously have to spend more than $400,000 to go buy your investment property. But if you want to increase the value of that asset that you've already got sitting right in front of you, you don't have to pay more stamp duty on, and you don't have to, potentially sell it and pay agents fees to then go upsize and buy a different investment or whatever you may want to do, is really just maximizing the asset that you've already got. So if you can go ahead and do a dual lock on it, if you can go ahead and put a granny flat in, all those bits and pieces, we can typically, when you're applying for a loan, you can include the negative gearing. Again, with most lenders, you include the negative gearing on the cost to do that build. So we just explain to the bank what you're doing. You might provide the build contract and all those bits and pieces as supporting evidence. We're just showing the bank what you're going to go ahead and build and get a valuation done, which obviously you have to do anyway. And that valuation will have in there what the expected rent is of that property as well. Which means you're going to get more for it. Right? That's just simple math. You've got $1 million block there that you might be able to rent the front house out for $750. You got to put a granny flat on the back and rent it out for $450, $500. The front rent's probably not going to change all that much. You know what I mean? They might lose some backyard. You might drop that front rent by $50, whatever it may be. But you're really maximising the asset. And you can use the negative gearing and the rental income from that second dwelling as well, which does help your borrowing capacity.
So there's a lot of brain melting conversation there. Like you have to be in the industry to be absolutely following that to a T. So I guess in simple terms, so when you've got yourself an opportunity to split the block or have the ability to put the granny flat on the block, the bank will look at it almost favourably and help you almost bankroll to your equity amount that you're available to use. And then with that, the capital gains that you've spoken to, and has also also come under a bit of scrutiny at the moment. Like that's all in danger.
Yep.
But
everything's always in danger.
everything in danger. Like we'll have a look at everybody, the everyday blokes spend before the governments, right? But at the end of the day, what we're going to, like, if somebody wants to build a granny flat, the bank will help you bankroll that in a construction loan, and as long as you've got the equity in the house, it can help. But because it's an asset and because you can rent it out, it would fall under the capital gains system, and you would be able to claim that back on tax and help you with your own place.
Yeah, I mean, normal tax rules apply, but it's going down the path of increasing the value of that asset.
Yeah. So almost I guess for information from us, when we're doing a design and when we're doing a build, particularly when someone's asking for a granny flat, granny flat standard floor space is roughly about 60 square meters.
That's the max still, isn't it? In
most spaces, yeah. So like, I mean, the rules can vary by a certain amount.
Are you building granny flats outside the maximum limit, Matthew?
No, not at all. But there is definitely a grey area. We can, I mean, there's dual lock opportunities. They don't have to split blocks. You don't have to do the torrents and the strata and all that kind of stuff. So ultimately, depending on your block size and all your bits and pieces, it could be quite a viable option, particularly for the first homeowners that are a little bit savvy in that development space, or that listen to our podcast could be able to take this info and at least start to pay attention to the places they buy.
And look, at the end of the day, if it increases your cash flow and the outlay is not as big as if you wanted to go and do a separate investment. I mean, most properties, when you purchase them off the bat, are negatively geared, right? If you've already got an investment property and you want to go spend again, I don't know, what's a granny flat, $350 these days? You go spend the granny flat and increase that overall revenue that's coming in. Right back to interest rates, even though I'm talking about borrowing more money, if it's cash flow positive, it's actually helping you. It's helping your cash flow. It's putting you in a stronger financial position. And again, it's another way you're sort of diversifying a little bit. Do you know what I mean? You've got more value in your overall property portfolio, but it's going to give you that little bit extra buffer too if you've got that extra cash coming in. So again, you have to borrow to go ahead and do the build unless you've got cash. You go ahead and do that build, you borrow more money. If interest rates go up, it's going to impact more of the cash and more of the debt that you've got, but you've got more of that cash flow coming in as well.
But what's quick math, what's 6% on $150,000 or $200,000 build?
This morning, I'm like, mate, it's too early for a 6% one. I don't know.
Well, it's like a 6% on a $200,000, like it almost pays for itself if you're renting it out properly. So I mean, obviously everybody's circumstances are specific to them, but on paper and logically, it works out to be a great result.
And I think people, it's a funny one to think about too, because when you're going down the granny flat path, just focusing on that one thing for a sec, most people have big blocks. Do you know what I mean? Like, it's certainly around here where we are, Lake Macquarie, Newcastle, blocks are sort of 600 to 800 is pretty standard, right?
We're pretty lucky. Yeah,
you get one. You get one with a bit of side access or whatever, mate. It's prime granny flat material. Now, whether that suits your lifestyle when you're mum and dad and 3 kids at home that want a big backyard, then no, you're not going to put a granny flat in and have someone living in your backyard. If you get a bit smart about it, the kids move out, you might still have a big block, but you don't want to maintain all that, and you also don't want to sell the family home. You get a bit smart. You look after all this stuff, not me, but you get a bit smart with your design and the access to the property, and you can bring in some extra cash flow you might have otherwise not thought about. I think people really need to think about that and maximize that opportunity, because it's easy to sort of go, to build a granny flat, I'm not a property developer, I don't know what to do, I've never built a house, I don't want to do it. It's like, no, you can actually look at it because there's a lot of value in that asset right there, and that may help you stay in that property longer. Do you know what I mean? Especially if you're retirees or whatever, and you say you plan on retiring in 5 years' time, you could build a granny flat out the back, and then you've got someone living there and you've got that extra cash flow coming in, and again, it might work out really well. But I think that sort of people don't think about it because it seems like it's a lot of work to do or whatever. It's like, just engage yourself. It's just a lot. And get the loan organised, and then off you go. So I think that people really need to start thinking about how they can maximise the asset they've already got.
Well, I mean, there's no shortage of renters, right? So at the end of the day, as long as you're in a red hot spot and you've got a bit of space, like it's pretty much a no brainer. A couple of mates, they need a spot to stay. Off you go in the granny flat, and away you go. But so I guess what would you recommend to the homeowners and the new buyers to I guess what are their first initial steps to start seeing you and to start implementing these ideas?
For a granny flat in particular?
For granny flat, dual locks, new builds.
Actually, I don't give two shits for anything. You need to talk to a broker first, right? You need to understand your financial position. And we would have touched on this last time we caught up. But at the end of the day, if the bank says no, the bank says no, right? That's my job. We deal with almost 30 different banks and all those sorts of bits and pieces. We've got a whole bunch of different policies that every bank is so different on policy, which you and I have spoken about a lot before in the past. But at the end of the day, if all banks say no and you can't organise the finance, your dreams just fall in a heap, right? It doesn't matter whether you want to buy an investment property, do a granny flat, do a dual lock, I don't know, move interstate. You need to get the finance organised at the start. And like I said, when we first kicked off the Savo, is that you also need to have plenty of buffer in that. Okay, so first thing is talk to your bank, talk to your broker, talk to whoever looks after your finance and go, can we do this? And is this really line ball? Like, do I really need to keep working 60 hours a week, smashing all this overtime just to make this work? Or actually, is this a comfortable idea? It's going to put us in a stronger position moving forward. First thing is always get the finance organised.
Getting a little bit savvy about where your money is. Start
exactly
like working out where your cash flow is, right? Like start knowing where you can start cutting the fat, the subscriptions, the Netflix, the Disney, all that kind of noise. Like as soon as you can start working out where you've got that fat to cut, then we can start working on it. And that's
I cut back on coffee.
That's gross.
Every single day, drive-through coffee joint. I love my drive-through coffee place, but every single time I go through there, man, you're spending good money.
Oh, mate, coffee, it's
a thing. I'm back to one a week now. My heart's slowed down a bit, which is nice. But it's the jokes aside, it is subscriptions, and it's small things like that, like an interest rate. One interest rate increase, unless your debt is astronomical, you're probably not going to notice it. And back to what we spoke about before, if we've had 3 interest rate cuts last year, 90% of people, again, this is going off NAB's figures, but 90% of people didn't reduce their payments. If they go back up once, you're actually still getting ahead on your loan.
Yeah.
So it's really not the end of the world, but you just need to be planning for what may come in the future.
Sure.
Which is just canning your binge subscription you never use because I know Game of Thrones finished or whatever the hell's going on, or canning Netflix, it's always the same shit every time, whatever it may be.
Yeah.
I mean, it is just really about tightening things up to ensure that if we do get more rate increases, it's not the end of the world.
So, and like I read a lot of stuff that goes on in the world at the moment, but as I dare say, everybody,
you do. Hey, I don't know when you sleep.
I don't. But we were talking about earlier today, the value of fixed rate. This is outside of the potty. We were talking earlier today.
Yep.
So you got the fixed rate, and you got the opportunity to do the variable and the fixed option. But you have a rate hold.
Rate lock.
A rate lock, sorry.
Yes.
So
yes,
rate hold, rate lock. So what does that mean? I know there's you can do interest only. That doesn't do you any favors. Actually, I at the very foundation of myself hate the fact that you do an interest rate only because you pay $1,600 and then you're still not going anywhere. But like if you've got the rate lock, like what's the value?
Yep. I think people need to realize that banks are selling money like products, right? Banks are selling money like a car salesman sells cars, right? They don't think about it as dollars. They think about it as a product, right? So their variable rate loan, that is a product that they offer, right? A credit card's a product they offer. Insurance is a product they offer. An overdraft, a fixed interest rate loan, whatever it may be. They're all separate products. So a lot of people think that when interest rates start to go up, I'm constantly telling people this, but a lot of people don't know, is that they sort of go, okay, I've got a great interest rate. Say my variable rate at the moment is 5.24%, right? That's a really good rate before the latest rate cut gets applied. A lot of people go, I want to fix that in. How long can I fix it in for? Can I fix it in for 5 years, right? Because most fixed interest rates are 1, 2, 3, 4, or 5 years. But most banks don't offer, well, no bank offers that, right? They offer a fixed rate product as a separate product. So go, you can fix your interest rate, but you've got to go over to this product. And then that fixed rate, what's been happening over the last couple of months is banks have been predicting the RBA would increase interest rates. They've already been, and this happened when we're coming out of COVID, they've already been increasing their fixed interest rates. So what we look at to try and get a bit of a gauge of where banks think rates are going is what are they doing with their fixed interest rates? Okay, so to go right back a step, when we were coming out of COVID, the whole world hadn't ended. We still had variable interest rates at say 2.3% or whatever it was. We had fixed interest rates at like 1.89 for 4 years. What happened is, again, as we all realised coming out of COVID, the whole world's not going to end and we all dealt with lockdowns and the economy didn't go to shit and all their house prices held up and all that sort of stuff, is that banks started rocketing up their fixed interest rates in readiness for the Reserve Bank to increase interest rates. When the Reserve Bank did their first interest rate increase, again, coming out of COVID, that's when it was talked about in the media. No one mentioned that, all the banks, not just the big four, was all the banks were actually rocketing up their fixed interest rates because they weren't going to keep offering, say, 1.89% for 4 years, right up until the Reserve Bank started increasing interest rates. You know what I mean? Because they're smarter than that, right? That's why they're richer than you and I combined, just a bit. So people need to realize they're different products, okay? So when it comes to fixing your interest rate, the first thing to do, again, talk to your broker or bank and try and figure out what works for you, because Depending on the situation, I think it's quite rare that someone should put 100% of their loan on a fixed interest rate. I don't love the idea of that because you lose a lot of the flexibility you have with a variable rate loan, okay? So I don't want to harp on about too much, but with a variable rate, you can typically make unlimited extra payments. You can redraw. Most banks offer free redraw these days. You can have offset accounts. Most banks offer multiple offset accounts these days. A lot more flexibility. Okay, so you take a variable rate loan, you smash it off in 5 years, legend. You own your house, you've saved a huge amount of interest, and that's great. If you go and fix in all of your loan, most banks will let you make some extra payments into a fixed rate loan, but not unlimited. There's a cap on that per year. You exceed the cap and you're potentially going to break the fixed rate. They can then charge you fixed rate break costs. Most banks don't allow you to redraw from a fixed rate loan, and most banks don't offer offset accounts on a fixed rate loan as well. So again, it's a completely different product. So to go back to your question, what you can do is split your loan and do part fixed, part variable. When we're going through COVID, I think every single loan that I wrote was part fixed, part variable.
Yeah.
Because you're looking at, say, a 4-year fixed rate. I think NAB had 1.89 or 1.99% for 4 years. So if you had a loan that was, say, 700,000, I was saying to people, why don't you fix in 650,000 for 4 years? And then the other 50,000 you leave variable of your total 700,000 loan. Smash off your variable rate as quick as you can.
Yeah.
And use that as sort of your incentive to pay off. So you are getting ahead on your loan, but make the most of this 1 point stupid percent interest rate that we had. And then when we came out of COVID and we all moved on with our lives, interest rates started going up. And then there was a talk about rates starting to come back down at some stage when inflation came back down, is that everyone just went 100% variable again.
Yeah.
And then which is fine. Like so did I, right? That's what most people have done. But now we're sort of back in that cycle again when there's talk of interest rates going up. So people are back to splitting their loan. A lot of people don't know you can do it. Now, some people would just do 50-50 because it's cleaner. Let's go, bugger it. We'll do 50% variable, 50% fixed. And at least you're sort of hedging your bets a bit. So if interest rates go up, say on a $500,000 loan, they're only going to go up on your 250.
Sure.
The other 250 you've got fixed in, they're not going to go up on. But again, you need to know that you're not going to be able to fix in that fixed interest, your variable interest rate just at what it is now. You've got to move over to a separate product, which typically has a higher interest rate. So you need to sort of account for that as well. And then, sorry, back on the rate lock, almost forgot. Yeah. So rate lock's a funny thing that a lot of people don't know about because it doesn't get talked about unless interest rates are starting to increase. So rate lock is a product which most banks offer. You got to pay for it. Surprise, surprise. Every bank's a bit different, but you're looking at somewhere around $500-600 on your average loan size. But that's allowing you to lock in your interest rate from the point of submitting your application.
Yeah,
okay. So you've got to remember, you submit an application to, say, buy a house, it's not going to settle for 6 weeks. Okay, so your application's submitted, it's sitting in the system with the bank, goes through the process, you get your formal approval a week later, great news, congratulations, and then you've still got another 5 weeks until you actually settle in the house and get the keys. Now, when interest rates are increasing, that is a hell of a long time for interest rates to go up. If the bank then just decides to increase interest rates on that 2 or 3 year fixed rate that you've elected to take out by 0.5%, guess what you get from settlement? You get the higher rate. So rate lock is a bit of a gamble because you are paying some money up front, and the bank charges that as a fee, but they will hold your rate from when you apply for the finance, when your application's submitted. So you are sort of giving yourself a bit of a gap in there.
But so you're basically promising yourself like a rate that may or may not be there. Like
it may not increase and you've lost your money. It's a gamble.
Yeah. So and at the moment, because it's so wild, like you almost have to be a fortune teller, right? So
exactly.
So yeah, it is a massive gamble, and the finance and the banking system is a huge gamble.
Yeah.
What can our listeners at home kind of prep themselves to kind of understand that that's what they're going to have to do?
Well, I mean, it sounds like a real wanky term, but it is arming yourself with knowledge. It's just knowing these things exist.
Yeah.
Very few people I talk to know what a rate lock. They've never heard a rate lock. And I've sort of gone through and explained to them, I go, that makes sense. And again, it really depends on your situation. Like there's plenty of people who I've spoken to, again, only in the last couple of weeks since men all talk about rates rising, and then obviously they did. There's plenty of people I talk to go, nah, bugger it, man. I don't give a shit. Let's just see what happens. And that's fine. If that suits your situation, it's not the end of the world. That's completely fine. But, if you're sort of a more cautious person when it comes to these sorts of things, you like more consistency, then you're going to want to pay the money and lock it in.
Yeah.
And just go, okay, that's it. That's done.
Yeah.
Forget the fee. I'm locking in the interest rate and I'm going to move on with my life.
Just hope it doesn't go down.
Hope it doesn't go down. No, with most banks, if it goes down, you actually get the lower rate.
Oh, right. Okay.
Yeah.
Okay.
It's not the end of the world.
Yeah. Well, what do you reckon at the moment? What do you think is one of the best banks to use at the moment out of the big four?
Out of the big four?
Yeah.
good Lord, it depends on your situation. Hey, if it's coming to self-employed, we're doing a lot with NAB. They've got some flexible policies around self-employed income. CommBank, I don't love CommBank. Their rates are not always the sharpest. They don't need to be the biggest bank in the country. But at the same time, we're doing a lot with the Westpac group, which includes St. George Bank as well, because their rates are quite competitive. But it all comes down to policies. Like I said, NAB's very good at self-employed. They've got a really sort of clear, straightforward policy around 1 year's financials. You go to Westpac, they've got 5 different ways to assess self-employed income, so it can get a bit convoluted and, just to be honest, get a little bit messy. Macquarie Bank, which is technically not in the big 5, they're pretty good at self-employed income as well. But there's also been some big changes around trust lending that they've walked away from recently. So it really depends on your situation. It's too hard a question to answer, but I wouldn't focus on, it's going to sound funny coming from a mortgage broker, I wouldn't focus on rate all that much.
Right. Okay.
Policy is the big thing.
Okay.
Policy is definitely the big thing.
And what would you suggest for people to start looking, like the first home buyers or the guys who are building in the construction space?
Yep.
What would you suggest they first go and review or even research in the banks, and what are the things that they should be watching out for in, I guess, their rates and the things that they should be watching for?
Serviceability. 100% serviceability. Yeah.
Okay.
Yeah.
And how would, like, let's say mum and dad,
because that's the end of it.
Yeah, right.
If you don't service, you don't service.
Yeah.
But there's no going to the bank and negotiating. There's no, hey, I've been banking with that bank for 20 years, so you know what I mean? I want to be able to borrow that money. It's like, no, if it doesn't service, it doesn't service. There's no policy exceptions on whether you can service a loan or not. Right? There's a lot. You've got to remember, this is not necessarily coming from the banks. I'm not defending the banks. I'm a broker, right? But a lot of this is government regulation and compliance. I'm not saying it's inappropriate, but it's government regulation and compliance to ensure that people can afford their loans long term. And we're not in a position where, you know, we're all having to sell our houses and we've got no buyers because no one can afford the loans in 3 years' time. So it's it's just one of those things where people need to sort of be armed with that knowledge around which bank's going to offer, you know, suit their situation. But again, it's getting in sort of early and understanding where that serviceability is, what you can borrow. And it does change a lot from bank to bank. Like I keep saying, a lot of it comes down to policy. Whether you're self-employed, whether it's PAYG, whether it's a construction loan, whether you're borrowing in a company name or a trust name, whether you're building a granny flat or a dual lock or a knockdown rebuild, a lot of banks are very different on policy.
So get blokes like yourself to sift through it all and nail it.
And it changes all the time too. Our bank policy changes all the time, all the time. And it's not always bad. It's not like lending's getting harder. People need to remember that banks are in the business of lending. That's how they make money, right? Like a lot of people go, the bank's not going to give me this money because this, or this. It's like, okay, that bank may not. Do you know what I mean? But this bank's policy is that they will.
Have a bit more risk.
Yeah, a bit more risk appetite around whatever it may be. Yeah. You know what I mean? And again, it's the market. So
sure. So you mentioned very, very quickly earlier that banks don't like to loan on like owner builders. At the moment, all the buzzwords are owner building because you're going to save 30 to 40%. There's systems in place now to help people do that kind of stuff.
Cost plus contracts are another one.
Cost plus contracts are a huge thing at the moment. So cost plus is where the builder basically gets the cost. They go, this is how much it's costing us, and this is the percentage that's on top of this. Now, they don't have a fixed rate, and that's part of a contract availability for a builder to a client. They say, and sometimes it can work out better for a client, sometimes it doesn't, but it gives the client a little bit more of a variability in I guess, the design and the build. Now, when I talk to a client about doing the cost plus, a cost plus build, usually they're pretty well off. Usually, they're usually
about to say exactly that. Yeah, they're usually people that have done it before. It's not their first time. It's not their first build. They're normally a bit more sophisticated in that area. I suppose it's a bit of a wanky term, but it's, you know, they've sort of done it before and they know they want a bit more control over it.
They know what they're doing.
Yeah, that's what we find with cost plus.
Yeah, and builders love it because they're like, they know what they're going to do. They know that there's the cost and we're going to make this much money out of this.
And you got to remember in that process too, the client whose property it is and the builder, they're going to have some sort of relationship, right? So these guys are working together. Okay, how can we do this? How can we do this? How can we do this? The bank's not necessarily going to see it that way. The bank just goes, show us the contract. Does that stack up or not? Yes or no? That's basically it. That's why banks love fixed price build contracts. to go back to the owner builder stuff as well. And again, the reason why I mentioned cost plus is that just from a bank's perspective, there's just more potential for variability.
Yeah.
Okay. And it's the same with owner builder, probably more so with owner builder, because owner builder, it's like, go and start doing what you're doing. But back what you're talking about before around fixtures and fittings and those sorts of things, like that's a minor thing. From a bank's perspective, if they just go, yeah, here's the money, but all of a sudden you start building something a bit different, because, you might change your mind halfway through, or your partner does, or you saw something that happened down the street and that looks really cool, and I'm going to adjust just a little bit here and there, and all of a sudden you get a big cost blowout, then that's going to impact, this is how the bank sees it anyway, it's going to impact their insecurity. Like, you've got to remember with a construction loan, banks are looking at what's the value of the property worth now, yep, fantastic, and what's the value of the property, like our security going to be at the end. That's what they're focused on. Yep. At the end of the day, the bank is protected by a mortgage, which means that if you don't pay your loan, they can come along and recoup their cost. And they need to make sure that's a saleable product.
Yeah.
If that's someone that's gone down the owner builder path and they've got 75% of the way through and run out of money because they've made some changes, and that does happen, how's the bank going to sell that house and recoup their cost? Now, there would be a market for it. There'll be some people that will come in and lowball. A builder might come in and go, I can finish that. I know exactly what I'm doing. I'm going to finish it in 3 months' time. I'm going to make a fortune. That's great. But it's going to limit the marketability of that property. And in the bank's eyes, that's going to put them in a more vulnerable position to recoup their cost. And that I understand.
Yeah. Well, I mean, it's always, there is always going to be some sort of level of risk, right? Like, I mean, builders are folding and going bust left, right, and center because numbers are not stacking up. They're not doing their numbers properly. At the end of the day, we're going to have unfinished houses that aren't done.
Well, you look at it coming out of COVID, man. It was insane.
Oh, it was crazy.
Through COVID, it was nuts. Yeah, there's builders going under all over the place.
Because you've got
everyone hated builders, but if the cost of everything went up, what the hell were they supposed to do?
And they've got a fixed price contract and that's where the stitch up comes from the builder, because they've got a fixed price contract at the moment while everything goes real low, and then they boost up that 30% for the material. We were getting variations issued across the board, and it was horrible. Yeah, well, like ideally, or technically, the builder can't turn around and go, oh, you know what, you've got the increase in the materials now in the last 6 months with 30%. Here's an extra. I had first going through, and then we're just going right back to the COVID thing again. I hate to keep harping on about it, but it was such a significant time for construction. There was plenty of times that I had phone calls with first home buyers or face-to-face meetings with first home buyers partway through the build and been issued with an $80,000 variation. They're going, can we increase the loan? I go, no, you can't. Yeah. Like, there's no more serviceability. You can't afford it. You don't have enough equity, you don't have enough income. Like, people are having to borrow money from friends and family just to get their build complete. There was first home buyers that I had that had a site manager or project manager, whatever he was at a particular build. I don't remember who it was, but he was in tears on the phone to them going, these price increases are going to ruin us. This wasn't a particularly big builder. And it was just like, these guys are ringing me going, Jesus, we just had this dude in the phone. He just said he can't finish your house and they need to pay this extra money. What do we do? And I go, guys, I can't get you the extra money. Like, you're tapped out. We can't help. Yeah.
Yeah, it was a hectic time.
It is a hard time, and it's still a hard time. People are still suffering.
And that happened with fixed price build contracts.
Yeah,
exactly. Fixed price build contracts.
Well, and then that's why there's been this huge shift between that fixed price build contract and having this emergence, I suppose, of like owner builder and this cost plus space that, quite frankly, banks don't want to touch, because there's nothing that's solid and tangible. Owner builder makes great sense. Oh, on paper, if you know what you're doing. Absolutely. If you've got the time, if you've got the time to do the owner builder every day of the week, like, owner builder is a bang on space. If you're not a wanker.
Just raised a super good point. Before you finish, in case I forget too, when banks are looking at, we're going on heaps of tangents here, but on owner builder in particular, what a lot of banks are looking for, like, this is the banks that will even consider owner builder, and again, they're pretty limited. If it's you and your offsider, maybe it's some dude and he's got 2 apprentices working for him, wherever it may be, and they're builders. If you're doing an owner builder job and we're saying that you weren't, $130,000 last year, and we're using that income to service the debt, the first question the bank's going to ask, and it's an obvious one but people don't realize, is how are you going to spend the next 6 months building your own house as an owner builder and still run your business? That's a big one for people to keep in mind. So the owner builder loans, and we do plenty of them, but the owner builder loans that typically go through a lot more without as many issues, are people that own a bigger business, and you can sort of go, well, it's owner builder, I'm using my company. I'm not physically building it myself. I've been off the tools for years, but I've got all my guys that do it. And we put all that information in the supporting notes when you're going through and doing an owner builder application. But there's a very big difference between, maybe a husband and wife that own a construction company with 10 or 15 guys working for them that can clearly get some of their blokes to build the house and still run their business and bring their income in so they can service the debt, compared to, mum and dad and maybe an apprentice that needs to be able to still run their business, do all those other jobs and get that income coming in, as well as build their own 4-bedroom, 3-bathroom house.
The best.
And that's what people forget. And I'm explaining to people, they go, "Oh shit, yeah, that's right." And I go, "Yeah."
Well, you've got to deal with it, right? Like, I've seen the owner builder course. It's very basic at the best of times.
Yeah, my brother did have to record a video of himself talking,
putting a hard hat on and trying to hold like a toolbox convo.
He told me
it's
it took him like
fantastic.
hours to get the recording right.
Yeah, absolutely, taking himself seriously.
Yeah.
But like at the end of the day, I would 100% say that mum and dad aren't going to do it. They're going to probably ask their mate. They're going to ask their brother. They're going to ask their father-in-law, son-in-law, blah blah blah, to run the show for them.
Yep.
The only reason they're going through it because they've seen this bright shiny 40% saving, and then they're like, well, you know what? Not understanding that the less money you pay people, the less likely they are going to put an effort in to get the job done.
Yep.
So, like, while owner builder is always a great op, like you've got to be in the industry. You got to know what you're talking about. You got to be at least a little bit active in that space.
I wouldn't do it.
No,
Not a chance in hell.
I'm in the industry. I've been in the industry for 20 years, but I still probably wouldn't do the owner builder because trying to organize all of the subcontractors is like trying to
Be a nightmare.
cats into a bath. It's just never going to happen.
And again, it's even the same thing. Like you need to go to work, run your business, just sitting here right now to service the debt.
Yeah,
I need to do the same. I need to go back to Aussie Home Loans and I keep writing home loans to service the debt. If my focus is taken off that and I've got to spend 30 hours a week organising trades, making sure guys rock up and all that, mate, you lose the income.
Getting a phone call at 3 o'clock in the afternoon. Oh, mate, I'm not going to get there today. I'll have to come in tomorrow. Oh, hang on,
I've been sitting here
I've got
since
the other
9,
guy guest here. But it's such a massive thing. And unfortunately, I mean, with the interest rate rising and the cost of living and all that kind of gross stuff that we can go on and crap on about all day, people are trying to save money in places that they shouldn't try to save money, and they need to trust their contractors, their builders, and whoever they need to. But there's just this, again, a perfect storm of just problems just kind of colliding of people trying to still get what they want and not go under.
Yep.
And it's such a wild thing to watch.
Yeah, but again, I don't think it's going to change.
No.
Like it's housing affordability is not going to change. To go right back to that, right? Like even if we do end up with, well, I think it's a supply and demand issue. I think everyone knows that. The government's admitted that themselves. Even if they do get the supply side right, what does that look like? So if the government all of a sudden clicked its fingers and managed to have another 30 million houses built across Australia tonight, you know what's going to happen? Your house ain't going to be worth shit. My house ain't going to be worth shit. His house ain't going to be worth shit. And everyone's going to be furious at the government. Yeah. You know what I mean? So it's a tough one. It's a tough one. We know that we need to have more houses to sort of fix that problem, but when's that going to change?
What's the people
you know, this perfect storm we're in that you talk about, and you're absolutely right.
Yeah.
We've been in it for years.
Yeah.
And we're probably going to continue to be in it. So people just need to be really smart about their own financial situation. Do you need that credit card? Do you need the new car? Can you pay your car off quicker? Can you extend your loan term to help out with your borrowing capacity when rates go up? Still try and pay your loan off quicker, but can you extend the loan term to give yourself a bit of that breathing space? Yeah. There's a lot of things you can do to sort of help out. Can you build a granny flat like we spoke about before and rent it out for $500 a week? Yes, you're borrowing more money, but is that a better way to improve your cash flow and the value of your overall asset? But I think people need to be really critical of their own financial position and go, are we doing this right, or could we do something a little bit different?
Like refinancing, consolidating, cutting away the fat that you don't really need. Maybe not getting that extra coffee through the drive-through every freaking day. It sucks. I understand that. But yeah,
leave the 10-pack of hard solos in the fridge.
For sure. But at the end of the day, I think paying attention to your money and where you're spending it. Paying attention to the people that you've got around and who you're using, making sure that your build and everything is contractually on point, and then just being a little bit savvy, I guess, with the interest rates and what they're going on. I mean, reading the news, and not read. Do people read the news anymore? Watching
they
the
listen
news.
to your podcast. That's all they do.
This
is where they get their news of the world, isn't it?
Don't do that. But at the end of the day, like as long as they're paying attention to what's going on and making an informed decision, and at least getting the professionals that know what they're doing and talking about at the start, is going to make sure that their run, at the very least, would be minimized of all the dramas than if you're just going.
Do you know what I think people can do to help out with this sort of stuff? And this is just, again, just becoming more aware. People don't need to become financial professionals, right? We don't all need to be, I don't know.
Everybody is now.
Economists and all this sort of jazz. Well, again, as a country, we are obsessed with property. So finance comes with that, and the economy comes with that. The Reserve Bank comes with that. Interest rates come with that, all that sort of stuff. It's literally just talking to people around you. Do you know what I mean? It's just having conversations with guys, having a few beers, and he's like, man, what's your interest rate?
Yeah.
Someone goes 5.19%. You're like, Jesus, man, I thought mine's at 6. Ring your missus and go, what's our interest rate? 6%. What the hell's going on? Like, just have that conversation.
How do we fix it?
You might talk, you might go then ring me broker, and the broker might say, oh, mate, this is that because, you know, you're at a 90% lend, you don't have as much equity, and, you know, we're limited on banks because of your position or whatever it may be. But it's just talking to people around you. I think there's a lot of value in that I don't think people in this country are too shy about finance, but I think there's a lot of value just in going, I mean, mate, bought an investment property. How did you do that? Or who did you talk to? And was that person any good or what? Like, what's the structure? None of this stuff is difficult, but if you sort of just have a chat with the people around you, whether it's friends and family or colleagues or whatever it may be, I think there's a lot that people can sort of learn from that.
I think
You and I talk about shit all the time.
All the time.
We don't learn anything. We're just talking to each other.
Exactly. We vent. We talk rubbish to each other all the time. We're never going to change the world, but I think some of the best steps at the moment to, I guess, alleviate the stress on the building industry and the costs of what would happen is I think. And I don't want to put a lot of pressure on the councils, but I think taking away, or at least halting, pausing, holding something like these contribution fees in trying to maintain or at least develop some sort of livable standard for everybody across these places with these big blocks. Yes, it is going to absolutely increase the value of their properties. And how a council are going to kind of claw that back. So I'm not saying stop the contribution fees forever.
Well, stuff needs to be paid for. I get what you mean.
I get that. But I mean, at the very least, just for now, maybe even pause it. Maybe just hold it off for the next.
Yeah, look, it's something that I think that governments need to look at. Here's you and I talking about what governments need to do. But is, you know, you've got local government, you've got councils, you've got state government, you've got federal government. Every single one of them can have a very significant impact, right? Typically, it's councils and approvals. State government level, it's typically giving councils the power for approvals. And the federal government level, it's typically funding and immigration and all those sorts of things that are at national level. So every level of government can certainly have an impact. Again, this isn't what you're saying, but if everyone went and built a granny flat in their backyard, again, flick of the fingers and that were built overnight, the congestion would be through the roof. There wouldn't be any room in hospitals and schools and all that sort of stuff. If we filled them up with people, right?
Absolutely.
So contributions need to come to pay for that. We all know that. We're acknowledging that. But you're right. Maybe if they pause them for a certain period of time, went, right, we're going to go through and do this build. But it is a hard one. Like you think about, again, I keep harping on about COVID. I don't quite know why. But remember all the grants that were coming in to encourage people to do renovations to their home and all those sorts of things?
Yeah, shot all the materials to the roof.
Shot the materials to the roof and that was skill shortage.
Yeah.
And you could have people working on your house at midnight.
Remember
they were allowed to do that? Yeah, people coming in and like cutting up bathrooms and replaced them at like midnight because they took away the restrictions.
Had holds on materials. Like nobody could get any materials because it was all
couldn't get anything.
Yeah.
No, you couldn't get anything. So again, it's always this balancing act. It's just trying to get that equilibrium right between, do you just go ahead and the government goes, righto, we're just going to stop all developer contributions the next 12 months. All that's going to happen is construction costs that go through the roof.
Construction costs would go through the roof, but I tell you what, mums and dads will go, I'm going to chuck a granny flat in my
Absolutely. I'm not saying it's a bad idea. It's probably a good idea. But
people will sit there and go, well, look, actually, hang on a minute. If there's no contribution fees, I've got 1,000 square meter block out here. I'm going to chuck a jaw lock. I'm going to chuck a jaw lock and save myself 30 grand. And you know what, how council recoup that later is up to a bloke that's smarter than myself. But I think at the end of the day, we've got to stop slogging the developers and mums and dads who maybe want to make a buck out of their block and potentially have a little bit more equity in the houses and the blocks that they have, rather than opening up extra space and land and selling those.
Again, it's people thinking about the asset they've gotten. Are you really making the most of it?
Absolutely, because I mean, like you look at the local estates just around the local area. They're selling big blocks now for 350 square meter blocks. Come on. So
the big block used to be 800, right? Wasn't that normal when we were kids?
Oh, it's what, and now they're calling a medium block So a big block now at the moment is 350 or something or other. But 550 squares was a large block and all that kind of stuff. It's just it's like, okay, it's not quite as big as you think it is anymore. And like Lake Macquarie, Newcastle Council, a few other councils will allow a split of a block that it's 600 square meters. That you can do a dual lock, you can do a granny flat on a block that's 600 square meters. You're paying a contribution fee of anywhere between $15,000 to $30,000. So it's not just the $20,000 in all the reporting, the ticks and balances that you have to do, but it's also the extra fees. If you're in the city of Newcastle, and let's say you're building a dual lock in New Lambton or something, you're getting hit with a 2%, maybe 3% extra a contribution fee on top of the contributions fees that come through from the top level all the way down to council.
Everything can just serve as, again, there's every level of government's got something that they can do, a thing that they can sort of change, but there's always going to be an impact, right? So you go talk to Newcastle Council and say, hey, what's this couple of percent on top? And they're going to go, yeah, we're funding this, this, and this. Now, you may not agree with that, and I may not agree with it, but that's what the explanation is going to be.
One of the best explanations in that contribution fee is it has to be this much or something of equal value. So it's like, all right, you're just writing yourself a blank check for something of value.
Of equal value.
So it's just like, so I think as a personal opinion, I think if we need more houses and if we need at least a little bit more leeway, I guess, in that livable space, I think maybe lowering those rates at the very least, or maybe putting a pause on it for a short period of time to maybe allow people to start getting these things through the process. They've got the time frames. The councils are smashing the time frames now. They've put things in place where they just knocks things out.
They're almost approved my plans very quickly.
Oh, it's amazing.
That you did. Thank you, Matthew.
The
lady at council told me they were great plans. I said, mate, look at mumbo jumbo to me. I don't know what's going on.
Well, I mean, as long if they're punching these plans through and if they're getting these ticks and balances checked properly, then at the very least, how much load is that 1 or 2 granny flats in that street in the next 6 to 12 months going to really have an effect on that sewer line? You know what I mean? Like, at the end of the day, they still pay for the they still pay for the connections, they still pay for the services to get connected. Really, where does that $30,000 go to? So that's what I think.
Another point.
Well, mate, thanks again for joining me tonight.
Thanks, mate. I appreciate it. It's been great, as always. I don't know if we covered any points that we spoke about, but I've had fun.
I think we did.
Did we?
I think we did. Yeah, I did. I think we did. We spoke about better cash flow and all that kind of stuff, and the importance of borrowing capacity in terms of the construction industry. But, mate, if there's anything ever that you want to come out and have a chat,
let's go back for round 3.
Mate, I love it. I really do. Thanks heaps, mate, for coming out again. And mate, I'll see you again.
Legend. Right. Thanks, mate.
Cheers, guys, for joining in again tonight, and I'll see you on the next episode of The Lounge. Thanks for listening to this week's ep of The Lounge. To make sure you don't miss out on the next episode, hit subscribe. We'd love to get the message out to more homeowners like you. Make sure you leave a rating and a review, and we'll see you on the next ep.